Okay, let's go ahead and go through the solution to the additional remeasurement problem. Again, here we have a trial balance denominated in Brazilian reals. The subsidiary Little was acquired by Big on January 1st, 2014. That date is critical. In this example, you're given a bunch of exchange rates for pre-2014. Those rates are irrelevant. Big acquired Little on January 1st, 2014, which means by extension that's when they acquired all of the non-financial assets that Little had at that time. So those rates are meaningless, irrelevant, of no use to us whatsoever. I'm just going to go ahead and avoid temptation by getting rid of them. Okay, let's go ahead and convert the trial balance at the appropriate exchange rates. Again, financial assets and liabilities get converted at the end of year exchange rate, or the current exchange rate. So the end of year exchange rate is 0.2. So cash and receivables converted at the current exchange rate. Our liabilities, starting with accounts payable, virtually all liabilities are financial liabilities. They get settled by paying cash. So we're going to use the current rate of 20 cents per Brazilian real. Let's go ahead and go back up here now. Inventories. Inventories being a non-financial assets, they're going to be converted at the rate that existed when those inventories were acquired. It says over here, assume the ending inventory was acquired when the exchange rate was 22 cents per real. So 0.22. Prepaid insurance. Insurance premium for a 2-year policy was paid on 10/1/13. Again, I deleted the 10/1/13 rate that was over here because it was irrelevant. We acquired Little on January 1st, 2014, so by extension we acquired that insurance policy on January 1st, 2014, when the exchange rate was 30 cents per real. Property, plant, and equipment. Another non-financial asset that needs to be converted at the rate that existed when it was acquired. So we've got a total of 350,000 reals of property, plant, and equipment, and they give us a little schedule here. Of that 350,000 reals, 250,000 was owned by Little when we acquired them, so that's going to be converted at the old January 1st rate of 30 cents per real. The remainder was acquired on April 7th when the exchange rate was 28 cents per real. So let's go ahead and do a little schedule for the property, plant, equipment, and basically we have old PPE versus new PPE. The old stuff, we had 250,000, the new stuff 100,000, for a total of 350. The exchange rates, again, the old stuff we're going to use the rate that existed when we acquired Little. The new stuff we're going to use the rate that existed on April 7th. So the dollar value is going to be the number of reals times the dollar value per reel, for total dollar value property, plant, and equipment of $103,000. So there's no individual exchange rate. Instead, the dollar to real conversion is based on a number of rates. While we're talking about property, plant, and equipment, let's also talk about the depreciation expense. And we'll have the same type of schedule here. But instead of being a property, plant, and equipment schedule, we'll call it a depreciation expense schedule. Again, we have a total depreciation expense of $32,500. Now it says that plant and equipment is depreciated over 10 years with a 0 expected salvage value. A full month's depreciation is taken in the month of acquisition. So let's look at the new property, plant, and equipment first. That had a cost of $100,000. It's going to be depreciated straight line over 10 years, so $10,000 per year. And we're going to round it off to the nearest whole month. So we bought this stuff on April 7th, so we're going to take depreciation for April through December, or 9/12 of a year. So $7,500 of depreciation on the new property, plant, and equipment. If the total is $32,500, then that means that the depreciation on the old equipment must have been 25,000 reals. And again, we're going to use the appropriate exchange rate. to determine the dollar amount of depreciation expense. So dollar depreciation, $9,600. And just as was the case with the asset itself, we have various exchange rates going into that computation. And then finally, let's look at the accumulated depreciation. Again, non-financial assets, we're going to convert the non-financial asset and all related accounts at the appropriate historical exchange rate. And so let's finally make up an accumulated depreciation schedule for our assets. And again, same drill as before. We have a total accumulated depreciation of 100,000 Brazilian reals. We have to break that down into old versus new. The new stuff that we just acquired had 7,500 reals of depreciation expense, so we would have 7,500 reals of accumulated depreciation. So if there's 100,000 total, 7,500 of which is new, then the old must be the other 92,500. And again, we use the appropriate exchange rate to convert those to dollars. So 29,850. Okay, intangible assets. It says the intangible assets were acquired 7/10/12 at a cost of 60,000 reals. They've been amortized for a while now. Again, the 7/10/12 is irrelevant as far as we're concerned. Time begins on January 1st, 14 when the exchange rate is 0.3. Okay, jumping down here. Additional paid-in the paid-in capital accounts, common stock and additional paid-in capital. We're going to use the historic rate from acquisition. Retained earnings in the first year of ownership, we use the historic rate from the date of acquisition. Subsequent to the first year, we'll carry forward the dollar amount from the previous year, and we'll talk about that at the end of this example. Okay, getting to the income statement. Sales. Again, ideally what would happen would be we would convert each individual sale at the rate that existed when that sale was made. Assuming the sales are made evenly throughout the year, we will use the average exchange rate as a reasonable approximation. Cost of goods sold. We're going to need a cost of goods sold schedule. Again, non-financial asset, when the non-financial asset inventory is sold, it generates the expense. So think of your cost of goods sold schedule. We have beginning inventory. We add our purchases, and that gives us our goods available for sale. We subtract out our ending inventory, and that gives us our cost of goods sold. Put a G on there. Okay, so what do we know? And again, we're going to need this both in Brazilian reals and dollars. Okay, I guess I should have written the same thing above all these other schedules. There we go. Okay, beginning inventory. It says beginning inventory was 83,900 British reals. The rate of that, the exchange rate for that beginning inventory, again, we acquired little on January 1st, 2014, and by extension we acquired that inventory at a rate of 30 cents per reel. Purchases, they don't tell us. They do tell us that purchases were made evenly throughout the year, but that doesn't do us a whole lot of good. I'm going to see if I can scoot that up a little bit. Just a touch. Okay, they don't tell us what the purchases were, but let's go ahead and fill in the rest of this and see what we can do. Cost of goods sold is given, 230,000 reals, and ending inventory is given as 95,000 reals. And so we should be able to fill in those missing blanks. If we have ending inventory of 95,000 and cost of goods sold of 330,000, then that means that goods available for sale must have been 325. If we had goods available for sale of 325 and we had beginning inventories of 83.9, then our purchases must have been the other 241,100. Okay, so let's go ahead and apply the appropriate exchange rates to these. Purchases made evenly throughout the year, and so we will use the average exchange rate as a reasonable approximation. And so let's go ahead and get the dollar values. 83,900 reals at 30 cents per reel is $25,170. Similarly, 241,100 reals at 25 cents a piece is $60,275. So our dollar value goods available for sale is 85,445. Ending inventory, it says ending inventory was acquired when the exchange rate was 22 cents per British reel. We've already got that up here in our balance sheet as ending inventory. So 22 cents. So we have dollar goods available for sale of 85,445. We have dollar ending inventory of about 21,000. And so we're going to have dollar cost of goods sold of about $65,000. $64,545. So again, another case where there's not a single exchange rate, but we have various exchange rates. Insurance expense. Again, here we're consuming or using up that prepaid insurance. The non-financial asset prepaid insurance is being converted at 30 cents, which means that when it's expensed, it's also converted at 30 cents per reel. Amortization expense, same thing. The intangible asset is being converted at 30 cents per reel, which means the associated amortization is also converted at 30 cents per reel. Operating expenses, the problem didn't state anything more about the operating expenses, so we sort of say, well, we assumed those were incurred evenly throughout the year, and so again, the average rate becomes a reasonable approximation. The last little schedule we need to make up is for dividends. It says dividends of 10,000 reals were declared and paid on April 7th, another 15,000 on October 9th. So basically we have two installments. We have 10,000 reals converted at the rate of, April 7th, 28 cents per reel. We have another 15,000 reals converted when the rate was 10,914, 23 cents per reel. So the resulting dollar figures, 10,000 times 28, 15,000 times 23, total dollar dividends 62.5. And again, various. Okay, so we've got all of our ducks lined up here, and now it's a matter of, again, spreadsheets make this so much easier. We simply say Brazilian real times the exchange rate, copy, Brazilian real times the exchange rate, copy, Brazilian real times the exchange rate, Brazilian real times the exchange rate. Okay, so everything's been expressed in dollars, and now we need to find out, again, this trial balance in the foreign currency balance. Trial balances by definition have to balance. Since we applied different rates to all the different financial statement elements, the resulting dollar denominated trial balance is not going to balance unless there's a really, really weird coincidence. So we need to figure out what do we need to make this thing balance? And please don't stumble at the end of the road here. We're going to add up our debits, add up our credits, and you need to be careful that you put the debits in the debit column and the credits in the credit column. So what do we have for debits? We have cash, receivables, inventory, prepaid insurance, plant and equipment, skip accumulated depreciation because it's a contra asset, intangibles, these are all liabilities, equity, sales, cost of goods sold, insurance expense, depreciation, amortization, operating, and dividends. Okay, so total debits, 284,590. Total credits, we have accumulated depreciation, accounts payable, taxes payable, interest payable, notes payable, bonds payable, common stock, additional paid-in capital, retained earnings, and sales. Okay, my debits exceed my credits, so I know that to make this thing balance, I'm going to need a credit to make it balance. And I'm going to need 73.20. So that's going to be my my remeasurement gain. Again, credits are gains, debits are losses. And again, the nice thing about remeasurement is this remeasurement gain is just going to get dumped into income like any other revenue or expense, gain or loss. So let's go ahead and do our income statement and our statement of retained earnings. And I'm just going to copy this stuff, my account titles, very conveniently. So for my income statement, I'll copy the dollar amounts too. Now, obviously, it should go without saying, but just to reiterate, dividends are not an expense, right? They don't go on the income statement. So we have our sales minus all of our various expenses, and now at the bottom of that, we're just going to go ahead and tack on, if I could spell properly, that remeasurement gain of 73.20. So our income is going to be sales minus all of our various expenses plus that remeasurement gain. So net income 15,540. And now let's go ahead and do our statement of retained earnings. We have our beginning retained earnings. We add our income. We subtract our dividends. And we get our ending retained earnings. So beginning retained earnings, $15,000. Income, $15,540. Dividends, $62.50. So ending retained earnings is beginning retained earnings plus income minus dividends, $24,290. So this is the amount that we're going to carry forward next year to the dollar value retained earnings. Again, the remeasurement gain got buried in income, and therefore it gets buried in retained earnings. In a sense, translation and remeasurement are very similar. They both generate this plug figure, either a remeasurement gain or loss or a translation gain or loss. The difference is how does that gain or loss get carried forward? Under remeasurement, the gain or loss gets buried in income and therefore buried in retained earnings. Under translation, the gain or loss is treated as other comprehensive income, and instead of being buried in retained earnings, is carried forward as accumulated other comprehensive income. So in both cases, that amount goes to equity in a sense, and it's going to get carried forward to the next year. It's just a question of, is it carried forward as part of the dollar value retained earnings, or is it carried forward as part of the dollar value accumulated other comprehensive income? Okay, so that's that.